Today, we're going to be talking about the best place to keep your cash. Surprise, it's not a bank.
Enjoy the episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host, Anthony Faso. If you guys have been watching the news over the last couple of weeks, you've seen them talk about some of the bank failures. I know you guys have seen it because even my wife has brought it up to me, surprisingly, and she does not look at the news. So there's a lot that's been going on. We've got a lot of inquiries from clients asking about the solvency of banks and insurance companies, and that's what we're going to talk to you guys about today.
Awesome. Looking forward to it.
Me too. Anthony, give these guys an overview. Why are people keeping money at banks?
Well, I think typically people store it at banks for really two reasons: safety and liquidity.
Mm-hmm.
And I think this recent time shows us that maybe that might not be so.
If you've been around for any extent, last 15 years, right? If you went through 2008, 10, 12, right in there, is you know that banks have some insecurity, right? They're not totally solvent. And so now we're kind of seeing that rear its ugly head once again.
Yeah. And in fact, 2008, 499 banks failed.
Ooh, that's a big number.
And I know we're going to get to it, but let's just kind of give them some of the dessert here. You know how many mutual insurance companies failed during that time?
I do know.
It was zero.
Yep.
Right. Zero. So there is a big difference of places. Well, there's a lot of similarities of storing. We got to store our cash somewhere. And there's a lot of similarities between using a bank or a whole life policy. There's also some major differences. And that's what we're going to discuss today. And I would say that by far the biggest difference is the way that banks run. Mm. And you may have heard of this. It's called fractional reserve banking.
Mm.
So Cameron, you want to enlighten the audience?
I would love to enlighten the audience. Fractional reserve banking is when I take $1 and I put it on deposit at a bank, is they don't keep that dollar on deposit. What they do is they keep a fraction of that dollar on deposit, thus fractional banking. So for example, I put $1 on deposit, they're keeping 10 cents on deposit. And then what they do is they turn around, they lend out 90 cents to Joe Schmo over here that's going to buy a TV, right? So then Joe Schmo goes and buys a TV and the seller comes in with, their $90 and they put that on deposit and they keep 9 cents. And then they turn around and they lend out 81 cents. Right. And so if you continue that example, what ends up happening is you have this ever expanding money supply. And the downside to this is that, man, if everybody comes calling, right, everybody comes running to the bank and says, hey, I want my money back that I have on deposit for you. If everyone does that at the same time, that's called a bank run. And what you're going to find out real quick, right, is that they don't actually have that money on deposit at the bank because it's all been loaned out. So if you guys have ever gone in and, tried to cash a check for, more than a few $1,000s, they probably told you to come back or go to a different branch. They just don't have the money on demand. And that is a result of fractional banking.
Well said, Cameron.
Thank you. You thought you had me there. I saw the look.
Oh, no, I always got you. Okay. And it's coming. What I think a prime example of this or in a movie is one of my favorite movies. It's a Wonderful Life. Right. And we had the Bailey Savings and Loan. Yeah. And if you remember, George is finally going to travel and he's on his way on his honeymoon and he sees this big crowd at the bank. So he pulls over and sees what's going on. And there was some concern. There was a run on the bank. People wanted to withdraw their deposits. And George got up and says, you know what, your money that's what we use to build Susie's house. And we have Joe's roof, so that to me as a young kid was the first example of a run on the bank. And another thing I want to point out of this movie is if you remember, again, it's a favorite movie, but it's a classic, right?
Yeah.
But Uncle Billy lost the night's deposit. And so the bank examiner was about to come and close the bank. And do you remember how George saved the bank?
Cash value.
He used his whole life policy, right? Just an interesting circle of events. But Cameron, as you were saying that, you know what I was thinking?
How good my hair looks?
No, I wasn't thinking that, dude. I know that. Okay. I know your hair looks good, but thank you for reminding me.
Got a haircut yesterday.
Is that's increasing the money supply.
Mm-hmm.
That is increasing the dollars that are out there. Isn't that what the true inflation is when there's more dollars out there?
Mm-hmm.
And then you amplify that with a low interest rate environment where it's more of an incentive for people to take loans, and that I guess what I'm saying is some of the government policy has been conducive of this inflation as well as what's going on in the banks.
Conducive is a nice way of putting it. I would say pouring gasoline on a fire is what I would say. And as you were talking, I had a thought.
How good my hair looks?
No, never. But
there was one time.
No, there was not one time.
Okay.
The thought that I had was, right, you and I are IBC practitioners. Like, we are fans of this. We've been in it for a very long time. And to be totally honest with you, when I read Nelson's book, I would put Nelson on one end of the spectrum in regards to, hey, his intention is to go out there and end the Federal Reserve.
Mm-hmm.
That never hit home with me, right? If I'm honest, like, I've always approached infinite banking from, hey, this is an advantage to me, like a very small personal level.
Mm-hmm. Mm-hmm.
And I started doing this way back when, and man, you know what? To be honest, it's only till recently that I've had kind of this bigger macro perspective of like, we're in trouble. Like, we are in some real trouble. And if I can contribute a little bit less to this inflationary system that we have going on, all the more better. And so that cause or that reason for doing infinite banking on a personal level has certainly risen over the last several years.
You know what I would say, because I have been doing infinite banking a day longer than you have. And honestly, I understood the idea behind ending the Fed, which really means ending the central banking system. But to me, as much as I would like that, I just didn't think it was possible.
Yeah.
Meaning the government, once they get a control, it's real hard for them to give it up. But this did re-engage maybe the importance of, or maybe the risk of this centralized banking system, the way the government's handling it can cause some risk.
Yeah, totally agree with you. Anthony, let's kind of jump back. I'm going to bring us back a little bit.
Thanks.
We kind of started talking, we were highlighting some of the differences, right? Again, you said we're going to give them the dessert up front. Guys, we've been kind of giving this message for a long time now, but obviously the best place to keep cash is in a whole life policy. We talked about how banks practice fractional reserve banking. Anthony, tell me a little bit about insurance companies and why they're different.
Well, when a bank takes a deposit, they need to put it to work, and they're going to put it to work by deploying it and loaning it to someone else. Those loans are illiquid, meaning if they want that money back, they can't. There's terms to that loan, so it's very hard for them to get the liquidity back. When insurance company is similar in some ways, when you pay premiums, they need to put that to work. They need to make sure the money's going to be there to pay that death claim. But the difference is they're putting it in liquid assets. They're buying and investments, which would mean, and really we looked at some of the stats on some of the mutual companies we work with, and was it 97% was in, or it was 76%?
Well, what are you referring to? The amount in cash and bonds? Yeah,
Mm-hmm.
It was 77.9.
Okay. 78%. Okay. Of their total assets are in something that is liquid, meaning that they could sell it if they needed to. So I want to point out two things, because one, somebody would ask, well, what if there's a run on insurance companies? All right. What if insurance companies, what if the bank crisis gets larger and then people run to the insurance companies to withdraw their funds? Now, a couple things to point out. Typically, when people are putting money in a bank, it's typically short-term use. right? That they're going to use that to pay their mortgage or to pay their bills and for groceries. Typically, when people put money inside a whole life policy, that's typically earmarked for long-term use. So thus, they may not need that. They're not relying on their cash value to pay their bills. Okay. And also, I would say in times of uncertainty, we need to store our cash somewhere. And the bank has shown some reasons to have some concerns and some that they are or can be vulnerable. So they'll be looking for a safe place to store their cash that is also liquid. So if anything, if this were to happen, people are more likely to go to store more money in their insurance company. And also, since almost 80% of the insurance company's assets are liquid, again, the time in need, they would have the ability to sell those assets if there was a liquidity issue.
Well said, Anthony.
I didn't say it, but banks cannot, I'm sorry, insurance companies don't have the luxury of practicing in fractional reserve banking. They're not allowed to do that. Much highly regulated.
Mm-hmm.
And, Cameron, when you were given that example of, the reserve requirement being 10%, you're being very conservative. Do you know what the reserve requirement is currently at banks? Well, I'll tell you.
Sorry.
I'm going to give you a hint.
It's rhetorical. I thought you were asking.
No, I will in a minute, but I'm going to give you a hint just so you get it. But that number of the reserves.
Same number of dates you had in high school.
It is not 2. Okay. It's not 2%.
Less.
It's less than that. It's the same number of mutual insurance companies that failed in 2008.
Oh, nice.
Right.
That was good.
So the government's lowered the reserve requirements, which does a couple things. For one, it's amplifying the fractional reserve banking, amplifying the amount of dollars that are in use, and it's making banks more susceptible for bank runs.
Yep. What's funny is you're talking, I was thinking the biggest demographic, I think, in my book of business, our book of business that's kind of grabbed on to infinite banking, I would say are clients that are probably 45 to maybe 60-ish.
Mm-hmm.
And the thought that I had was, man, they've been beat up, right? They've been beat up from the stock market. They've been beat up from banks back in 2008, right? And they've seen some of these things that we're starting to see happen again. And when you look at this product and you look at some of the features just on the guarantees and the certainty that come along with it, it makes sense, right? It makes sense for somebody to take a look at it and be like, man, this is where I should be keeping my cash. So, I mean,
it's interesting. That's where a bulk of our clients are, but we also work with many people that are younger. And honestly, I think I'm pumped when we get, I've worked with a couple of people that were still in college. Right. Or some that were soon out. I think that they saw what their parents went through during the Great Recession, and they don't trust the market. I think they've taken the blinders off at a young age.
Mm-hmm.
And man, if you start this when you're in your 20s, I mean, you are going to be set.
Yeah.
I mean, it's going to be awesome.
Yeah.
Now, what I would say, but we do work with a lot of investors, where a lot of times it's people that are in the cusp. They want to be investors or are fairly new to it. And what we've realized, and we call it the cash cycle of investors, is what most investors will do is they need to store their money where they believe it's safe and liquid. And they're typically going to choose a bank to do that. They put the money in there as they're saving up to buy an investment, and then when they do, they buy the asset. That asset should produce either cash flow or future profits, but when they get those future profits or cash flows, they got to put it somewhere, so they put it back in the bank. And then they want to buy another asset. So they save up money in that bank, and then they go and deploy it, buy another asset that produces cash flow and profits. And we put that in the bank. And maybe sometimes they might take some money out for profit or lifestyle. But what they're really doing is they're just recycling the money through the banking system, which that is good.
Mm-hmm.
But I think with these certain times, what that shows is that there is some risk. And again, as I alluded to earlier, when there's risk or panic, there's opportunities. I mean, I would hate for an investor who's sitting on a ton of cash and that their bank goes under. And let's just say FDIC or the government comes in and saves the day, right? That could take some time. They could lose on some opportunities as well. And in the simplest terms, what we're talking about here for those investors, we got to store the cash somewhere. And you're looking for safety and liquidity. Whole life policy is just as liquid, and I think now has shown is even more safe than banks. But in addition to that, it earns a much higher rate of return. That rate of return is tax-free. Each state has some level of asset protection. So now if you were to get sued and the money's in the bank, they may be able to take it. If it's in your policy, it's going to be much more difficult. And again, the biggest opportunity is where we don't need to drain the account to buy the asset. We borrow against it, which will allow the money inside our policy continuing to grow even while we are using it. So we've been talking for years about whole life is a better place to store your capital. And I think right now it's just is a prime example of that.
Yeah, we've really highlighted the better returns. We haven't highlighted really the instability of banks as being that option. You guys, if you're listening to this episode and you're thinking, man, this might be for me, maybe I've got some cash that's sitting in a checking account. You know, it's too much to kind of have on hand, but you're not quite sure what to do with it. Reach out to us. We're happy to kind of spend some time with you, give you some options on what you might be able to do and see if infinite banking is a good fit for you. The link is going to be in the show notes. Feel free to reach out to us. And if you're lucky, you'll end up on my calendar.
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.